Good afternoon to our friends on the East Coast, and for our friends joining us on the West Coast, good late morning. My name is Julian Frazo. I'm your Director of Risk Management here at Pointe. So welcome to our quarterly macro and markets update, February 2023 edition with our Chief Investment Officer, Michael Dow. So we got a lot to cover today, but before we bring Michael to get the party started, just a couple of housekeeping items. If you have questions, we will get to your questions throughout the course of the call today. And that's actually why we budget 90 minutes for these calls. We get a lot of great questions for you, from you, our audience, and we want to make sure that we have time for Michael to address a fair number of those. We may not have time to get to all questions, but if you do have questions, type it into the Q&A box at the bottom of the Zoom screen, and we will address those throughout the course of the presentation today. As always, we're joined by our Chief Investment Officer, Michael Dow, and Michael's going to walk us through a review of the first 6 or 7 weeks of 2023. So as you know, 2023 is off to a great start, but can it last? That's what we're going to discuss. Michael will then revisit our secular thesis of financial repression and where that stands. In the next section, we are going to talk about our cyclical thesis, which is the late cycle dynamics and some of the market implication of that. And finally, we will wrap up the outlook for 2023 and how to position portfolios to take advantage of some of the macro themes that we're seeing take place in the market today. As always, with our private clients, as well as our institutional clients, everyone has a different risk tolerance, a different time frame, a different investment objective for their portfolios. And that's why our advisors and our institutional consulting teams work very closely with you on an individual basis to use all of this information that we're going to discuss today, as well as additional information about your specific needs to align your wealth with what matters most when building portfolios. So without further ado, Michael, the floor is yours.
Julian, thank you very much. We have, as Julian mentioned, there's a lot to talk about today. We're going to take a look back and a look forward. We're going to try to put the recent market into context. And ultimately, what we're trying to get to is answer a few questions that you have about macro and markets, and to let you all know what we're thinking about as we strive to build the best portfolios for you on a risk-adjusted basis. So let's jump right into what's been happening in the last 14 months or so. This is the S&P 500 going back to January of 2022. 3 days in, we hit the recent all-time record. Subsequent to that, we had a lot of fears of Fed rate hikes in the first quarter of 2022, and they finally pulled the trigger in March of 2022, causing both the equity and the bond markets to decline dramatically. So the first half of the year was a minus 24 plus or minus. We hit this bottom here in June, then rallied back 17%, then down 17%. And then since mid-October, we've been on a pretty good tear up to where we stand today at about 4136 on the S&P 500. It was a good fourth quarter after 3 horrible quarters, a good fourth quarter of 2022, finishing at 7.6. And from the lows in October, adding in not only the October, November, and December periods, but January and Feb, we're up 15.6%. So we've come a fair bit back from the very low depths of October, but we're not back to the record high yet, and may not get there anytime soon. I'll talk about that. What we've seen here is something very traditional. It's a late cycle increase in equity market volatility. It's hard to recall a year where you have a couple of minus 20s or a minus 16, minus 17, plus 17, plus 16. It doesn't happen like that very often, and it's because of the fact that the market is now debating what kind of a recession we're going to have and when the Fed is going to be done raising interest rates. Every time you see a green rally here bar, that's because the fears of recession have overwhelmed the fears of Fed rate hikes. The orange periods when the equity market's declining is the fear of Fed rate hikes. So it's really a tug of war between this recession fear, which seems counterintuitive. Why would a fear of recession cause the equity market to rise? And the answer is it's the second order effect. If we're having a recession, the Federal Reserve is likely to stop putting the brakes on the economy. They're likely to reverse course or pivot and actually start to either become neutral about monetary policy or actually lower interest rates in an attempt to be more accommodative. So this what we've seen since we entered the late cycle in the fourth quarter 2021, or just over 15 months ago, in our view, is an increase in equity market volatility. The next chart actually shows what the implications are for the bond market, and they're not that surprising. If the Fed is raising interest rates, 2-year yields and 10-year yields are going to go up. The blue line here is Fed funds starting the year 14 months ago at 25 basis points, ending the year at 4.5%, and now with the February rate hike 2 weeks ago, we're up to 4 3/4. The 2-year note, which is the orange line here, has also seen a pretty steady climb of the mountain, that is from 73 basis points all the way up to 472. We actually got some relief on 2-year notes when there was, again, more fear of a recession. And this is where you see more of a direct relationship between a recessionary environment and a bond market rally. Bonds tend to rally in a recession because the Fed then is expected to start lowering interest rates. And you see that first in 2-year notes. So what we've got is 4 movements in the equity markets here, which is slightly different than what we saw in the bond market. The bond market has shown just in the last 2 weeks, and we're going to talk about what's happened in the last 2 weeks in a minute. But in the last 2 weeks, the bond market has shown another sell-off of fear of Fed rate hikes, but it has not yet worked its way into the equity market. The implication, of course, is that there's potentially some headwinds for the equity market. As long as the bond market thinks we're going to raise interest rates further and maybe higher than the terminal rate we were looking at before, things are going to be a little bit challenging. So just to put a fine point on what the story of 2022 was. 2022 was very simple. You started to see Fed rate hikes in March, and they raised rates in the fastest pace since 1981. They raised rates 425 basis points in 9 months. This is Fed funds here. Over on the left chart is the balance sheet of the Federal Reserve. And this is a quantitative easing mode. That is, the balance sheet is increasing. These are monthly purchases in the Fed's balance sheet. So or changes in the size of the balance sheet, actually total net of purchases and redemptions. So changes in the size of the Fed balance sheet, these increases indicate quantitative easing. A negative number over here, which we've seen since last March when they stopped purchasing their large-scale asset purchase program, you see negative numbers. So the balance sheet reduction was accelerating. January wasn't so big, but I think that's just a function of maturities. Bottom line is, you shouldn't expect the equity market to play nice while the Federal Reserve is reducing monetary policy accommodation and, in fact, tightening. We'll see that they just got to neutral. They're not even what I would say tight in terms of versus a real interest rate. They're actually just neutral right now. But that's part of the reason that's okay, is because monetary policy works on long and variable lags. So the Federal Reserve has raised interest rates at a very good clip, also used another tool in their toolkit, which is the reduction in the size of their balance sheet to tighten financial conditions, and they're doing so in an attempt to crush inflation. Here's 2022 again, and I just want to highlight a couple of things. 2022 and 3-year and 10-year returns for the same asset classes. So here's the S&P 500. It was down 18% in 2022. Those are the blue bars. They're all negative. But if you look at a longer term horizon, and this is an important point to make to all investors, 3 and 10 years, you can see the equity and bond market returns here are reasonably positive. The 3-year numbers for bonds are actually very unusual. You hardly ever see a 3-year period where bonds don't make money. This is the first time it's ever happened. But the equity markets are positive for 3 years. And that translates into positive returns for your portfolio, whether you're benchmarked to the municipal bond index or to the Lehman aggregate index or the Barclays Bloomberg index. These are portfolio returns for a typical 60-40 or a 70-30. This is a 60-40 benchmarked against munis. This is a 60-40 benchmarked against the aggregate. And again, over a 10-year period, you're getting 5-6% returns annualized. And that's the key. You got to really ignore, to the extent possible, the short-term pain that was associated with the first 3 quarters of 2022, because short-term pain is inextricably linked to long-term gain. And don't think about the numbers. These numbers are kind of random number generators over short periods of time. The outlook for the U.S. economy didn't change dramatically when we reached a peak of 4,700 on the S&P 14 months ago. There was not like an all clear signal that all of a sudden, we're looking at, a whole new scenario where it's all clear, and the stock market's just going to go up, and the economy is going to continue to run at a very rapid clip. The economy was overheating 14 months ago, maybe overheating again now. And as a result, the Federal Reserve did what they're supposed to do, which is to clamp down on the economy in an attempt to keep inflation from getting embedded and becoming more persistent. This is a long time series here. It goes back to 1990, and it's the percentage of mutual fund categories that lost money. So back in 94, it was a pretty bad year as well. 80% of mutual fund categories lost money, 94% in 2008. 79% in 2018, and in 2022 was a really bad year. No place to hide. It was a bad year to be an asset allocator. So what we generally see, though, after these very difficult years is, of course, you see better years, fewer categories in the negative. So you should invest through the cycle. One or two bad years does not a portfolio make. Julian, is there a question?
Yes, there's a few questions already on the chat, but I wanted to mention one in particular that we already talk about the interest rates going higher and the Fed increasing basically the value of the price of money. And so the question was about how does that affect alternative investments like REIT and the long market? And I guess I would really extend the question to how does that affect equities and all asset classes really?
So I'm sorry, I missed the first part of that. I was actually reading one of the other questions. Julian, could you repeat the question for me?
The question was really about how interest rate increase are affecting alternative investments,
Alternative investments.
Yeah, so, like REIT and the loan market.
On a less timely basis is the answer to that question. Interest rates do have an impact on fundamental or intrinsic value of a real estate asset or some of the other alternative assets that we invest in. The benefit of having an alternative structure, though, where you're not subject to the tyranny of mark-to-market or daily pricing, is that you can kind of look through some of the short-term fluctuations. Interest rates go through cycles, and our alternative investments have a tendency to basically smooth out the cycles because they're not daily priced, they're not publicly priced in the equity market or in the bond market, which is for some that's difficult to accept. For me, it actually is a better matchup between the actual asset that's being invested in. A real estate asset has a 30-year, 50-year, 100-year life. Whereas, what does it matter that the bond or the REIT that is investing in those assets fluctuates over short periods of time? The asset is going to generate cash flow for a very long time. So matching the vehicle with the economic life of the asset is one of the benefits of investing in alternatives. But interest rates affect everything. They affect whether they're private alternative vehicles or public vehicles. Interest rates affect everything. They're the discount rate for the cash flows. Any asset that we would have you invest in is an asset that generally has a cash flow, with the exception of some real assets or gold. And those real asset cash flows need to be discounted back to the present, and that's simply the fundamental value or the price of the asset. So interest rates affect everything, whether it's an alternative asset or a publicly traded asset. I'm going to go ahead and just grab a question from Joe asking about the probability of a no scenario landing. I'm not going to give you the preview. I'm going to talk a lot about that. The people at Apollo and the chief economist there is Torsten Slok. He is the one that has begun a discussion about a potential no landing scenario as opposed to a soft landing or a recession. You're going to get enough information on that to answer any questions you have about it in coming slides. I'll just give you the preview. Just really quickly, this is actually an interesting chart. 2022 returns are on the bottom. This is equities over here. You've got bond markets here. You've got the dollar index here. The only one that's different is the dollar index. You can see that. Why? Because the dollar is flip-flopped, and that's also caused EFA and EM to perform. The returns since mid-October are in the red bars, by the way. So mid-October 22 until yesterday, the S&P's returned 16%. It was down 18% in 2022. So, you've got this the same kind of dynamics happening. The story of 2022 was Fed rate hikes versus recession. Story of 2023 has been the same, and the recession or the Fed pivot has dominated the talk. But I think there's a new element to discuss, and that is referenced in the no landing scenario. So back in 2022, the assets that were most exposed to interest rates did the worst, and that would be tech and basically growth assets. So the Russell 1000 growth did the worst. It's recovered some, but it's actually the international equities that have done really well since October of 2022, and that's partly because the US dollar has seen a reversal. Most important chart today, you got to stay invested. If you stay invested, this is a chart that goes back to 1925. I presented it in December as well. And back in the day, what you're seeing here is effectively green is bull markets and orange is bear markets. So green and the magnitude, the size of the boxes indicate how much wealth is being created or how much wealth is actually being destroyed. It's the distance and the cumulative return for an expansion. From November of 46 to December of 61, there was a 15-year long expansion, and equities were up almost 1,000%. We also had a very strong bull market. There was a couple of wiggles in here from February 9. It's how you calculate it. It's based on monthly returns, not on daily returns. But just highlight this for a moment. Much more green than orange. You need to be invested to build wealth. Bull markets build wealth. Bear markets are just a temporary phenomena. We can't time it. No one can. You shouldn't try. You should identify what your risk profile is, and you should stay invested. And know that the short term is the short term, and it'll go away unless you think the U.S. economy is no longer a going concern, which I don't think anybody does. But stock prices don't accurately reflect on a daily basis the intrinsic value of the U.S. economy or corporate America. They do not. They incorporate other features, fear, greed, other things. So you got to look through the short-term price volatility because it doesn't reflect the actual intrinsic value of the underlying investments. I'm going to skip that one and just highlight, this is, again, the period from October, mid-October until now versus 2020. 2020 is blue since mid-October. The last 5 months is in the red here. So the portfolio returns, if you had a 60-40 portfolio, for example, you were down 14% in 2022, but you're up 13%. How are you going to time that? Did everyone know? Was there a bell ringing in the middle of October that said, now it's time to get back in the market? Absolutely not. No one knows when it's going to turn up. And frankly, it's not something to focus on. I know you hear that a lot, and it's very difficult to do, particularly for private clients, but institutions ignore the short term all the time. And I think the more private clients focus on it, the better. So where are we now? We're looking at that's our good recap. Julian, is there anything that anybody has asked that seems interesting or relevant to some of the topics I've addressed already? Or is there something, or should I jump right into global growth? You decide.
No, I think you can jump into global growth. There were questions about staying invested, but I think you addressed that with the charts we just saw. Why in hindsight it's always easy to say, well, last year would have been better to be in cash, but it's really hard to predict when to get out. So that's why you want to stay invested. There's otherwise there's question about the no landing scenario. I think we're going to address that now.
Yep. And also, there's a question about emerging markets as well. I'm just going to say this. Emerging markets have been disappointing, but at some point, they're so disappointing that their valuation becomes compelling. And it's all about, in many cases, growth rates outside the U.S., interest rate differentials that produce foreign exchange differentials. And frankly, there's the argument to invest outside of the U.S. in international developed and international EM has grown dramatically. I don't have a lot of comments about electric car markets, battery storage, et cetera. There's a big deal going on between Tesla and the administration right now, but we don't do any research on that. It's certainly going to be an important theme going forward, and for the companies, the specific companies that are involved in EV and electronic car that are likely to be a big deal going forward, especially if the world is evolving as we think it might. So, but we're not making any investment themes based on that. We look at more macro themes that drive large and persistent changes in capital asset prices. It's why we look at the macroeconomy and why we don't make judgments about individual equity securities or, frankly, that granular level of sectors. Where are we in the global growth cycle? Well, global growth peaked. I always start this conversation with global, because how you feel about U.S. equities or U.S. bonds and other investments that we would make on your behalf begins with an assessment of the macroeconomic environment. And if you just looked at the U.S., you're going to miss sometimes the forest from the trees. So we start with global growth. Global growth peaked back in the summer of 2021. You can see that through the J.P. Morgan global purchasing manager indices. These are just high frequency economic indices. Anything above a 50 is an expansion. Anything below is in contraction. We're right there on the expansion contraction line. And things have been going downhill since. If you're in the green, you're good over here. These are various regions and countries. And what you see is that basically on a global basis, we've been what appears to be kind of in a recessionary environment for the last 4 or 5 months. Why? Because of all of the interest rate hikes that we've seen across global central banks. Global central banks get what global central banks want. And if there's an inflation issue in your country and you're a global central banker or policymaker, you're going to raise interest rates. Interest rates, 63 rate hikes, 63 rate hikes in the last 3 months, 235 rate hikes across all global central banks in the last year. Turkey was the lone rate cut, which is surprising since their inflation rate's running at about 50% annualized. Why would Turkey cut rates? Very good question. At a point in time about 5 years ago, the president of Turkey actually appointed his brother-in-law as the head of the central bank. So there may not be as what we would call orthodox monetary policy happening in Turkey, and there hasn't been for a long time. Interest rates, that is global central bank interest rates in the EM, they started first, and now they were averaging about 2.3%. Now global central bank rates in the EM are averaging close to 7.25%. The Swiss National Bank and the Bank of Japan are still negative. So the developed market central bank average interest rate this is the global policy rate for developed is 2.7, but it's gone up very, very dramatically. But it's the Fed at 4.5 and 4.75 is actually much higher than the average, partly because Japan and Swissy are still negative, surprisingly negative. Swiss National Bank is a minus 75 basis point policy rate. So yet here's the big four: U.S., the Fed, Bank of England, the European Central Bank, and Japan. Japan has not raised interest rates; they're still minus 10 basis points for their policy rate. The ECB and the UK are up in the 4s now, and the Fed is close to pushing 5 now. So where are we on the global business cycle? We're in the late bit. I mean, this is where we've been. Are we going to get a soft landing? That's a very good question. Could be a recession. We're going to talk a lot about this, or again, what Torsten has promulgated down in Apollo is the no landing scenario. So what is no landing? It's really just an overheating scenario, and it has elements of both. I would call it a soft landing and then ultimately a recession, and we'll talk about that in a second. So what is the big story? It might be China reopening. So 2023 is about China putting a lot of economic stimulus into the markets. It's about what kind of a recession or landing we're going to get here in the United States. And if we can get both of those things at least partly right, I think we'll be okay. I'm not going to talk a lot about China except to say their GDP in 2021 was 8.4, but last year was only 3. The forecast for 2023 in China, this is the reopening thesis, is 5.2. How do you get there? Well, China has a credit impulse. It's how the banking system supports the economy. It's the all system financing or credit stimulus in billions of renminbi. And this is at a very high level, second only to a period of time back in the first part of 2022. So there's a lot of credit stimulus going on. And these indicators, which is, this is the China Purchasing Managers Index, it's also the high frequency economic indicators, are starting to both turn up, and there's some room for the manufacturing PMI to rise above 50. So China is going to have a positive effect on global growth. It may also have a pretty significant effect on commodity prices. Like to start here before we start talking about the cyclical environment here in the US, and I hope to wrap up in about 40 minutes and make sure we've got a lot of time for questions. So that's going to be challenging if you're me, the way I like to go into a lot of detail. But here's where we are in stocks. Very strong start, up 6.3% in the US. The developed markets, actually plus EM, is up 8%. And I'm just suggesting the market's probably getting a little ahead of itself. The S&P up 8.5 now. This is January's numbers. The S&P is up 8.5 now. But corporate profits are likely to have something else to say about that. They've started to leak a little bit, as you normally see. Corporate profit estimates at the beginning of the year tend to come down or be revised downward, and we're starting to see that. But we've had this big rally since the October lows, up to 15% now. Federal Reserve has done what it can to fight inflation. It's going to do more. They're tightening financial conditions. That's how they do it. The Federal Reserve operates under a financial conditions framework. We're going to talk more about that. It's specifically designed to slow the economy, potentially throw a few people out of work. If the job openings doesn't provide a safety valve, then the unemployment rate's going to rise. And if they can do that, then they'll get a handle on inflation, and it will go down. There's no better correction or prescription, I guess, for an inflationary environment than a good old-fashioned recession. And that's what the Fed will do if necessary. 2022 in the economy, we got a 2.1% GDP number. We're not going to get that in 2023. The Fed's interest rates, the hikes starting last March, and the reduction in their balance sheet, that is their tightening of monetary policy, working on longer lags, is starting to bite. It's certainly already bitten the housing market. Jay Powell's focused on core services, price increases, or core services inflation, ex-housing. The housing data in the CPI is not turned down yet. It's actually still rising, but you know it's in the pipeline because other housing data, more frequent housing data, suggests that it is. But the real key here is, can other things that are what we call CPI core services, ex-housing, can that come down in terms of prices? And if not, the economy is going to go lower. Interest rates down 3 basis points only year to date, although it's been a bit of a volatile year to date for the 10-year. We were down as low as 340, but now we're only down -3. It's in the last 2 weeks, 10-year yields have gone up 40 basis points or 30 basis points. It's been a pretty good move. 2-year yields have gone up also 30 or 40 basis points. So interest rates much higher over the course of the last 14 or 15 months. I think we've seen the peak in 10-year yields. We've seen the peak in 10-year yields with the possible exception of a no landing scenario. If we get a no landing scenario, all bets are off. A no landing scenario is effectively persistent inflation or higher inflation. That is what we've seen to date in terms of the inflation environment moderating, is something that was related specifically to the supply chains, but the goods markets have not yet achieved the same kind of benefit. So I just want to say where we stand right now, it all depends on the Fed. The Fed depends on inflation, and inflation depends on the labor market. So keep that in mind. Julian, is there a question?
Yes, there was specifically one that is a good time to discuss about the inverted yield curve, with the 2-year clearly being above the 10-year, and if that's, it can predict any recession. Basically, is that a signal of an upcoming recession?
2s 10s historically has some predictive power, but I like to look at 3-month T-bills versus 10-year yields. So 2s 10s inverted last April or May, and we haven't had a recession. Well, we probably were in kind of a recession. GDP was negative in the first half of 2022, but the 2 by 10-year yield curve, which is now minus 80 basis points, plus or minus, is a pretty good. It's one of many factors you would want to look at to predict a recession. Some would say it actually, it doesn't predict a recession per se, but is a result of slower economic growth and the Fed expectations in the 2-year note for the Fed to lower interest rates. Do you have another question, Julian, or no?
Well, I would follow up just with, I think it'd be interesting to quantify, what these 3 concepts are: recession, soft landing, and no landing. You put some numbers, because even the definition of recession sometimes is depending on who you ask, you get different answers. So
that's true. The U.S. is the only country that doesn't define, well, that I'm aware of in the OECD anyway. 2 quarters of negative GDP growth is a recession in most countries. We had 2 quarters of negative GDP growth here in the U.S. in the first and second quarters of last year, but we have an entity called the National Bureau of Economic Research, the NBER. They look at a broad swath of indicators. And because the labor market is a big chunk of the indicators that they focus on, not just GDP per se, the labor market has been so strong that to date, they haven't declared a recession. They might 2 years from now look back at the first half of 2022 and we may get a recession out of the NBER. But as it stands today, there's too much strength in the US economy. Let me wrap around to the yield curve point again. 3-month T-bills versus 10-year yields, and there's a chart in here on that, is a little bit better predictor of the recessions of the 8 or so recessions we've had in the post-World War II period, 8 or 9. And the idea that you can use one metric to focus on is not probably good. And every downturn, every recession has unique features, and there's nothing that is similar about the current economic environment we're in. It's part of the reason why it's very difficult to move our portfolios off of anything more than what I would call neutral. And to those that are asking questions about why you would invest in certain assets if you think they're going to go down, the answer is no one knows if they're really going to go down, and we don't really focus on the short term anyway. So while they may go down in the short run, that's a given. What I think is also a given is the U.S. economy is a going concern, which means they're going to recover. So I guess what I'm saying is, as it relates to a recessionary environment and holding assets that are likely to suffer, I mean, everything is on a probability distribution. So there is no guarantee that the one guarantee you had was, perhaps bond prices would go down as the Federal Reserve is raising interest rates. You just didn't know how much, and you didn't know when they were going to stop doing it. So you would shade the portfolio to somewhat less interest rate risk, which is what we did in the fourth quarter of 2021 in the strategy portfolios. Not everybody got that, but if you were in a Beacon Point strategy portfolio, you did, and that helped protect the downside. And again, it's not about absolute returns. It's about returns relative to what the market has on offer, which is another way of saying it's benchmark relative. So if the market's down 20 and you're down 14, that's a home run. If the market's down, up 10 and you're only up 6, I would consider that to be a failure on our part, at least on my part as the CIO. I would want to be able to say to you that the baseline you should expect is what the market's offering on a risk-adjusted basis and subject to your own risk profile, liquidity needs, and desire for an aversion to significant negative drawdowns. So that your risk profile has everything to do with that. But once you identify your actual risk profile, you should stick with it. We should get through the secular bit pretty quickly because there's lots to talk about in the no landing scenario, the recession and the soft. So many of you have already heard the secular investment theme. It's been our theme for the last 2.5 years. What exactly is financial repression? It's the ability and the willingness of the federal government to get the U.S. Treasury and the Federal Reserve on board together to collude effectively in a good way to keep nominal interest rates low and let inflation run a little bit hot so that you have negative real interest rates. Negative real interest rates are the hallmark of financial repression. Why do you do it? Here's why. Basically, we hit 129% debt to GDP. It's a debt issue. And we are going to talk very briefly about the debt ceiling. This is why the debt ceiling is going to be a hot topic over the next 4 or 5 months. It's because debt in the United States has reached the highest level since World War II. So what do you do? What happens to your budget when the debt rises dramatically? The answer is, and this was Phil Swagel, the head of the Congressional Budget Office in Washington, published this report yesterday. And what it tells you is that the amount of debt to GDP is likely to go up by 20%. This, by the way, is percentage of federal debt. You have to add 20% more to this number to get the total debt that's we're looking at here. That includes state and local. This number includes state and local. This is just the federal debt. So as of today, the federal debt's 98. We're at probably 124%. So you add 22 or 24% more of debt that's at the state and local level, and you get a pretty darn big number. The problem is once the debt rises to this level, and should interest rates increase at all, you're going to have, it's going to be a big chunk of the budget. In fact, the expectations from the CBO are that interest payments on the debt, which are a function of both the mountain of debt and, frankly, rising interest rates. Financial repression is meant to collapse interest rates. You can't get rid of the debt without defaulting or paying it off or raising taxes. So let's forget about that. What you want to do is inflate the debt away by having inflation run at 3%, not 2%, and that's financial repression. And have your central bank buy up enough debt from the Treasury, who's going to have to continue issuing debt, so that nominal interest rates are low. So your actual debt costs are low, and you can manage them. And over time, and it takes 10 years, you can try to whittle down the debt mountain. So that's what financial repression is all about, and we're likely to have to revisit that scenario sometime in 2024. Why? What can the Fed do? The Fed can fight inflation or it can repress interest rates. It can't do both. So when core inflation started to blow through some of these standard deviations here, core inflation is the blue line. The headline peaked, by the way, at 9.1% in June. Now we're down to 6.4, but the core number only got to 6.6 and it's only down to 5.6. So core inflation is now going lower, but it was in line with the most recent forecast. This is inflation. The Fed, and this goes back to 93. These numbers are off the chart. We haven't seen them since the early 80s, right? So the question is, what can the Fed do about this? The answer is they have to put financial repression on pause. So they can't repress interest rates and fight inflation at the same time. They just can't do both. So once you get to this point, you have to put financial repression on pause, but it'll be back. The Fed can do itself a lot of favors by talking tough. So that's the third element of the Fed's policy toolkit. One is raising interest rates. The other is buying or selling securities. That's quantitative easing or quantitative tightening. The third is their communications policy. So what they say about what they're going to do is also a tool. And they've used that very effectively to make sure that inflation expectations, these are longer term inflation expectations. This number here is the market expected inflation from 2028 until 2032. If this number goes above 2.5, the Fed gets very upset, at least since 2012, because they need to keep their inflation fighting credibility intact. If they're a credible inflation fighting central bank, they don't have to raise interest rates as much. So this is the key, and they will jealously guard their inflation fighting credibility, I guarantee. So if this number starts to turn back up, and by the way, 1 year break even inflation numbers, the shorter term numbers have turned up pretty significantly in the last 2 weeks. Two things have happened in the last 2 weeks. We'll talk about them. One, it was a blowout labor market report on February 3rd, more than 500,000 new jobs added, and then a very disappointing inflation number on Tuesday. So sad Valentine's Day inflation number, and the labor number, very good for workers, very bad if you're focused on trying to get the Fed to pivot. I mentioned this just real quickly. This is negative real interest rates. These are real interest rates. They're negative here in the kind of the 2011, 2012 period. They were negative for an extended period from the end of 2019 or 2020, about middle of 2020 until about 9 months ago. Interest rates were negative on a real basis. That is, you take the nominal amount and you subtract out inflation. That's the real interest rate. The real interest rate is what matters for bonds. If real interest rates are positive, you might be able to say bonds are attractive. If real interest rates are negative, they are unattractive. And you want to reduce your interest rate risk in this environment. You may want to increase it like we've done 4 or 5 months ago when you have positive real yields. So that is financial repression. Now, 40 minutes in, we can start talking about the current cyclical environment. Late cycle dynamics, that's what we've been calling the cyclical environment we're in. We moved effectively from let's go back. So here's where we were about 15 months ago or 5 quarters ago. Here's where we are now. We're in the late cycle. We either get a soft landing, we get a recession, or the new talk of the town is, do we get a no landing, which to me means an overheating economy met with a response by the Fed, which creates a deeper contraction in the future than we would have expected otherwise. It's not a soft landing. It's a temporary overheating that's met by much higher interest rates from the Federal Reserve. This would be the most challenging market. It's a great market for the equity market in the meantime until the bond market decides that the inflation is not coming down and that the Federal Reserve is going to have to do more. And if that's the case, then we're going to have a very difficult time in equities. Let me put a fine point on where we stand in terms of summarizing the late cycle dynamics. The CPI number that came out 2 weeks ago, we're still kind of in the highest inflation in the last 40-year environment. The economy's slowing. The fourth quarter came in at 2.9, but it was very depressing 2.9. Final sales to consumers here, domestic consumption was very low, and that's the more important number. This number is flattered by a lack of imports, so it wasn't a strong GDP number. Neither was the third quarter, by the way. Fourth quarter we're looking, or first quarter 2023 flat or negative. Second quarter flat or negative. So it's going to be a difficult economic environment in the first half. But it's shocking. shocking how strong the labor market is. The unemployment rate's at a 54-year low. It is literally on fire. So the Fed was forced to act. That was the story of 2022. It will be the story of 2023. In 2022, you had historic underperformance in the bond market, and you're not going to get a repeat of that in 2023 because interest rates are much higher. So bond market has a bit of a self-correction mechanism. When interest rates go up and prices go down, your running yield going forward is much higher. So I don't see a repeat of the same underperformance in the bond market in 2023. In 2022, you had the massive increase in capital market, particularly equity market volatility, and it manifested in minus 18% in the S&P. Maybe you get a repeat. Probably not that bad, but if you have a scenario where the Fed is forced to get a little more aggressive, it's going to be challenging again. That's just my expectation at this point and subject to change. I'd like to tell you that it was all clear, but it won't be until the Fed's done raising interest rates. And the Fed won't be done with the kind of inflation prints that we've seen. This is just a bunch of other inflation measures besides the CPI headline. CPI headline month over month. So this is the momentum indicators you're seeing here. And it's just sliced up 4 different ways. Headline and then core. Core is X food and energy is the green. Headline is in the blue. Both were kind of on a nice trajectory here in the second half of 2022, but now they've kind of reaccelerated, and this is the potential no landing scenario. So you got service prices, which are, they were slowing. That's what you wanted to see. This is the supply chain healing, right? So the goods prices were actually declining for a period of time because supply chains healed and price pressures declined on goods, but not in services. Services prices were kind of decreasing, but they're also on an upswing. So core and services prices, that's the green and the orange is what you want to focus. Sorry, green and the gray is what you want to focus on. Both of those are moving in the wrong direction. That's why I said it was a pretty horrible number that we got on February 14th. So just a bad inflation print. The housing market is deflating. I'm going to just leave this as red because it's pretty simple to understand. Here's the mortgage rates went from 3% to 7%. Mortgage house price increases then collapsed. So the housing market is suffering disinflation. It's less high inflation, it's disinflation. So there you have it. Here's the number that Jay Powell mentioned about 15 times in his press conference after the February FOMC meeting. It's another slice or dice of the CPI, and it's important to understand the components of CPI to get a handle on what the Fed's going to do. The purple here is what's called core services less shelter. So this is the number that the Federal Reserve is focused on, and Jay Powell in particular. What you need to see is this number, flatlining at 1 or 2 tenths per month. 2 tenths per month is an annualized. You can kind of just cuff it and say that times 12, 0.2 times 12 means 2.4% plus or minus on an annualized basis. So 6 tenths per month. Multiply that by 6, that's a 7% run rate. And that's exactly where the year-over-year numbers are for the CPI core services less shelter. And that's the key number right there. This 7.2 is a shockingly high number, even though headline has come down, 250, 300 basis points almost. This number is the number that's going to keep the Fed on its toes, and it's going to make sure the Fed is continuously vigilant about inflation. When this number rolls over, we'll be in better shape. So the Fed has a dual mandate. Everybody probably understands that by now. They either it's price stability and maximum employment. So for 13 years after the great financial crisis, all they wanted to do was try to get the unemployment rate down much lower, and inflation was no problem. The Fed is now single-mindedly focused on inflation, which means they might have to give up something. The teeter-totter is here to represent that these two things are in competition. You can't fight inflation and support the labor market or the economy at the same time, because fighting inflation means raising interest rates and slowing the economy. So now we're going to see an increase in the unemployment rate if necessary. There's a new twist in the environment today, and that's that there's about 11 million job openings and only about 5 or 6 million unemployed people. So the job openings is actually a safety valve for the unemployment rate. You don't have to throw people out of work if you can just pull the "we're hiring" sign from the front window. So that's something to think about. We may not have to see a big hike in the unemployment rate as long as the job openings come down. But in the meantime, Jay is channeling hawkish Paul Volcker a hero of those of us that watch the Federal Reserve. He was the Federal Reserve chairman from 1979 to 87. He's the one that basically is credited with establishing the Federal Reserve's reputation as a credible inflation fighter. He basically set us on a path of excellent economic growth from the early 80s until the great financial crisis, and even subsequent to that. Price stability, the ability to control inflation, that's the only thing that matters in the long run in terms of economic decision making. Over time, economic growth will be higher if you have a credible inflation fighting central bank. So that's where we stand. How does the Fed do it? The Fed actually operates on what we're calling a financial conditions framework. They have to tighten financial conditions to fight inflation. By tightening financial conditions, they slow the economy and reduce price pressures. That's what they do. How do they tighten financial conditions? They only have direct control over interest rates. So they raise short-term interest rates, but because the interest rate is the discounting mechanism for equity prices and other things, it increases the S&P's volatility and it lowers the S&P's price. The Fed, by raising interest rates, provides a headwind. I mean, they're not trying to knock the equity markets down 25%. They're actually just trying to slow economic growth, but part of that comes from a wealth effect, and having the equity market go down also increases the cost of funding for corporate America. All of these things are effectively the cost of funds for corporate America, or they have a wealth effect. If the cost of funds is low, then economic activity 2 to 4 quarters out is high. If the cost of funding a project in the U.S. economy is high, then economic growth will be low. Corporate bond spreads and interest rates and equity market volatility are all integral to the cost of doing business in the United States. So by affecting the short-term interest rate, by raising it, and it affects all of these other items that they don't have direct control over, but that react in a very well understood way, they can slow the economy. That's how they manage the economy. These are the components of any of the more popular financial conditions indices. Here's one, the Goldman Sachs indice, financial conditions index. The blue line here, it's pretty highly correlated to the S&P 500 level. It was, except for the most recent environment. Why? Because there's other stuff associated with it. S&P vol, corporate bond spreads, and US dollar are the other elements of the financial conditions index. What can you glean from this chart? Well, bond spreads must have widened, interest rates must be much higher, and the US dollar must have been appreciating dramatically. And that's exactly what happened in 2022. And in fact, when we look at I'll just say this, the Fed's not happy with this recent loosening because they don't have inflation under control yet. So if the financial conditions index isn't doing what they want it to do, then they will do more to make sure that it does. And that means probably lowering equity prices, probably increasing equity market vol. It certainly means raising interest rates another 50 to 75 basis points from here. Here are the other features of the financial conditions index, by the way. Oh, before I go there, Julian, is there a question?
Yeah, on that topic, I guess there was a question about how you would feel about being invested in treasuries, for the short term and rolling into stocks later on in the year, or trying to time it, at the right time, the expansion of the economy.
Tell me when that trade doesn't work anymore, and I'll tell you that's what you should do. I mean, if you're worried about the equity market going down in the near term, it seems like a pretty appropriate thing to do to just park in T-bills at 4.5%, and in some cases closer to 5%. But that's a short-term trade. No, that's what you're doing. You're making a trade. The trade is you're giving up the equity upside and you're protecting yourself from the equity downside at the same time. But you're very likely to miss whatever the next upturn is. And if you have more than a 6-month or a 12-month investment horizon, it's probably not a great strategy. For a portion of your assets, it might be okay. If it makes you sleep better at night, to put 5% of your assets in T-bills so that at least 5% or so of your assets aren't going to go down, they're going to go up 4.5%, fine. But that is a short-term trade. You're making a trade, you're making a bet, and you're timing the market. So that's kind of what I think. I don't think. Go ahead, Julian.
Sorry to interrupt. Yeah, there's a few more questions, but I'm sure you're going to address them when we go talk about the implications. But maybe one you could discuss now is about the consumer, the state of the consumer, and what will it take for the consumer to basically not be able to spend anymore, blow out of their savings?
So there's two really important things to try and get a handle on. One is the excess savings that were built up by the consumer subsequent to all of the stimulus that was used to support the economy after the economy shut down post-COVID. So there was a ton of stimulus, a lot of checks went out the door, interest rates were lowered. Folks basically banked a lot of that. Excess savings were substantial. Those are coming down now. The levels of excess savings seem to be declining to levels that may or may not be supportive of the economy anymore. The other thing is the unemployment rate. If you have a job, you spend money. If you don't have a job, you don't. So if the unemployment rate goes up, then the consumer will, by definition, weaken. So those are the things to focus on. There's a lot of questions about like how to invest and move portfolios around. There's a question on the Q&A right now. What I want to do is take that one offline because everybody has a specific set of circumstances that may or may not allow them to get it fully invested. But I'll tell you, I mean, we're not wholesale moving assets out of the portfolio. When we talk about changing or cyclical adjustments that we do in the portfolios that are related to how we see the business cycle evolving, those changes are really small. You can even consider them enhanced rebalancing. The most important decision that you can make as an investor is to figure out what your actual risk profile is. Another way of saying is how much money do you want 10 years from now? Because your risk and your return are inextricably linked. So if you're willing to give up some money in the future, then you should have a lower risk profile. If you want to maximize your money in the future, yet you're willing to take, a lot of volatility, then you should maximize your risk taking. You should actually be more what we call risk neutral as opposed to risk seeking or risk averse. Risk neutral just means you properly assess the risks associated with being invested in the capital markets and you do what's best for you and push your utility to the highest level. But here's what I would say. The changes we make in the portfolio are on the margin, 3, 5, 7% kind of moves max. And the 7% moves are likely to come in the bond market. So one of the things we did, and a lot of portfolios, but not every single one, was 15 months ago, reduced interest rate risk. So that's kind of how do we do that? If you had a 20% allocation to bonds, we put 6% of it in a short duration fund. That's all. We just reduce the overall duration of the portfolio. And I look at things at the portfolio level, not at the individual manager level. That's really important consideration. Individual manager performance is secondary, very secondary to how that manager contributes or how that bond portfolio contributes to the overall portfolio's return, and that overall portfolio's return versus what the market did. Another way of saying your overall portfolio versus the benchmark that is represented by, if you're a growth client, you're a 70-30 client, that means you're 70% equity, 30% ag, or 30% munis. Measuring your performance against a benchmark is a very important thing to do, in my opinion. It's the way institutions do it, certainly. All institutions do it that way, and that's how we either retain clients or get fired, to be honest. And if private clients were able to embrace a little bit of that, not all of it, not completely, at least get in the ballpark of it, that would probably be very helpful because it's relative returns. You can't get blood from a stone, as we say. You can't have up 20 if the market's down 5. You want to be happy with -5 if the market's -10. I guess is how I would describe it. This is the most important chart. This tells you that the move in the terminal Fed funds rate, by the way, here's all the Fed rate hikes we've seen since March of 2022. And this is the market's expectation for where the end of the Fed rate hike cycle would be. It kept ratcheting up. I mean, when we started raising rates back in March a year ago, the max that the market was expecting was 3% on Fed funds. By the time October rolled around, it was 5, and now we're at 5.25. So the market has missed that pretty conclusively. Why? Because inflation has been more persistent. And just in the last 2 weeks, this is where we were 2 weeks ago in terms of Fed funds going all the way out until December of 2024. This is the market's expectations for the path of Fed funds between now and 2 years from now. And what it said was just 2 weeks ago, 491 was going to be the peak. The current is now 524. It's up 30 plus basis points in the last 2 weeks because we had that blowout labor market number and because we had that poor inflation print. So is 5.25 the peak? It depends on what kind of a landing we get. Here's that 517 new jobs and non-farm payrolls that we got. Here's the real, I mentioned job openings versus unemployed people. There's 11 million job openings and 5.5 million unemployed people. So there's almost 2 job openings for every available worker. That's why wages remain strong. That's why inflation is such a problem. The Fed looks at this metric as much as they look at the core services ex shelter metric. So the 2 things you want to know is what's the job openings to unemployed people look like, and what does core services ex shelter look like? They've not been able to slow the economy so far, and that's where Torsten and team at Apollo have decided, you know, they got to have consider a no landing scenario. In fact, here's the outlook. The inflation numbers are too high. The Fed was forced to act. We talked about their dual mandate. They're either focusing on inflation or they're focusing on maximum employment. They're focused on inflation now. And by squeezing the economy lower, we're either going to get a soft landing, a recession, or no. The inflation, by the way, is a product of oil, strong labor. It's really the strong labor market that's driving it now. The supply chain imbalance has reduced its effect on inflation data now. And you see that because goods prices were at one point falling, but services prices remain high. So the Fed has to raise rates. They have to try and dampen the upward pressure on interest rates. This, I showed you this chart earlier. It's the Fed's balance sheet and its interest rate hikes. So the Fed balance sheet declining and interest rate hikes are going to be the story of 2023 too. It's just that we're already here. We started 2022 here in terms of Fed rate hikes. They raised rates 450 basis points in the last 12 months, 425 through the end of the year. And this is kind of where the market sees them going. But the point is, this is what the Fed does. Here's an interesting chart. This chart it takes into consideration all 3 of the tools. The Fed's communication, the bully pulpit, their ability to talk about where things are headed and to keep the pressure on the economy by talking, as opposed to raising interest rates or actually selling down securities in their long-term asset portfolio or quantitative tightening. And this is just a proxy. This blue line here tries to, the orange line is actual Fed funds. So Fed funds is at 462 now, going back 20 years here. Fed funds is at 462. For a while, this number, the blue line is actually the proxy that takes into consideration not just the Fed funds rate, but it assigns increases or decreases in the Fed's balance sheet, a rate hike or a rate cut factor, a proxy for it. So even though the Fed funds rate's at 462, because you saw all of this decline in the Fed's balance sheet in the last 7 months, what you really have is an effective proxy for Fed funds that's closer to 6% than 462. What does that mean? It just means the Fed has more tools than just raising interest rates in order to manage to tighten or to loosen financial conditions. During the whole great financial crisis period, they were much looser than Fed funds could be because you reach the effective zero bound. You can't lower interest rates below zero on a nominal basis. We're not set up for that. They did it in the ECB and they're still doing it at the Swiss National Bank, Bank of Japan, but we're not set up for that. So the proxy for the Fed funds rate includes the effect of the balance sheet transactions. So conditions are much tighter than they appear, but they're still just neutral. So this is monetary policy is tight when you get this number in positive territory. It's still a negative. Again, the current Fed funds mid, it's the range is 4.5 to 4 3/4. So the mid of that is 4 5/8. We were at minus 5% net of inflation. This is the real number. So you take 4 3/4 or 4 5/8 and you subtract the PCE core price index, which is actually 4.6 as well, and you get a real Fed funds number. When real Fed funds is minus 5, it's the loosest monetary policy ever. Right now, we're just back to neutral. That's all. So there are more Fed rate hikes to come because we're just barely neutral. What happens when the Fed raises rates? 7 out of 8 times, they throw us into a recession. Only in 94 did they raise rates 300 basis points. This is the change in rates, or the actual Fed funds rate. Got to 3%, but we didn't have a recession. Recessions are these blue dotted line periods. So every other time, there's 8 of those recessions since 1963. 7 out of 8, we had a recession. So, but this one's different. The labor market is much stronger now than it has been in any of these other recessions. So you have to take that into consideration. Okay. macro probabilities. Everybody wants to know what the probability of each of these things is. So I'm just going to say this and reserve the right to change it at any time. I think a soft landing or a Goldilocks type environment is 1 in 3. It's gotten higher, actually, I think, because the market is focused on soft landing. Market's actually down 50 basis points today, was down a lot more on the open. Recession is the conventional wisdom. So, I ascribe about a 50% probability of that. What about an overheating economy and a no landing? We don't get a landing. We don't land at all. I'll show you in a couple slides what that means for certain metrics, including labor market metrics, GDP, inflation, and the unemployment rate, et cetera. So no landing is really just an overheating scenario where you get first a soft and then a recession. What happens to the markets? I don't know, but I would say you could probably look for a terminal Fed funds rate and unemployment rate in a stock market that looks kind of like this. And again, I totally reserve the right to change these numbers with new information. But if you held to a forecast, I would say by the second half of 2023, a no landing scenario means Fed funds goes to 6. And that'll put a lot of pressure on equity markets and the economy. So first, what'll happen is if you just get an outright, we just have a garden variety recession, we get through it. And by the second half, things are probably okay. Terminal Fed funds, we're back down to 4.5 after reaching 5.25, something like that. That's what throws us into a recession. Other terminal Fed funds in the soft landing, they only have to do one more 25. That's maybe 2, whatever. Unemployment rate doesn't go up much. It's 3.4 right now. Unemployment rate, though, in the no landing scenario gets up to 4.5 or maybe even higher, and that's bad for the stock market. So this is how we think about the world. There has to be some kind of a theme or a thesis to how equity markets and bond markets evolve, and this is where we're at right now. I'm going to go through a couple more slides real quick and jump to the portfolios, how we position. But I think it's important to just do a little more work on soft landing, recession, and no landing, and what it means, particularly for these 6 economic metrics. All 3 on this page are related to the labor market. And what you see here is simply a representation of what would happen under the no landing. No landing, participation rate increases, job openings also increase, and the unemployment, because there's more activity, and in fact, the unemployment rate declines. Whereas in a recession, the unemployment rate is going to do a button hook and go not to 7. This is not what I would say is not to scale. But if you were to scale it, it would look maybe like something like this. So you may get to 5%. So that's recession, that's soft landing, that's no landing for a variety of different things. The safety valve for the wages is this. You can reduce pressure on wages and hence pressure on inflation if you just remove the we're hiring sign. Instead of actually firing people, this is firing people in the unemployment rate. This is, hey, we have a job available. Both of those keep wages, high or pressure on wages. But if the Fed could do this is what the Fed wants. The Fed wants the job openings number to come down meaningfully, and they may get that. That would be representative of a soft landing. Here we're looking at GDP, inflation, and Fed funds. Under the no landing scenario, GDP accelerates, inflation also accelerates, and not surprisingly, Fed funds also accelerates. Okay. Soft landing, we kind of muddle along, maybe 2.5% GDP. In a recession, we're going to probably, go much below. Okay, so let's see where we're at here now. Probability of recession. This is a heat map which shows a bunch of indicators that we look at. I'm going to skip that one and talk about the market implications. Julian, is there a question?
Yeah, there are a couple of questions about the labor market and trying to understand why is it so strong, if there are some political reasons behind the fact that you have all these job openings, like basically restriction or work visas. And I think part of the answer is probably demographics. So maybe if you can address explain what some reason for the strength of the labor market, if there's anything political there that could be addressed.
I don't know. I mean, the labor market has a lot of factors that influence this current phenomena. I mean, people made different choices post-COVID is the biggest thing. They retired, or they decided they didn't want to work as much as they did before, and that's a choice. So that's why there's so many, so few unemployed workers. If you're not looking for a job, you don't factor into the 5.5 million of unemployed workers. And that's why the job openings over unemployed workers is near two times. So that's one thing. Yeah, that's all I want to say about that. All I know is the effect on inflation is it's going to press it higher and wages will be higher. What else? So how about a 10-year yield? And then I'll talk about, because that's part of the market implications. Why do I think the 10-year yields peak? Because when I made that call 6 months ago, we were at 4%. We actually got to 4.25%, which was my target. And it was lucky. I'll just be honest, that never happens. But I felt like the Fed's stranglehold on the economy was likely to start biting. We would have a recession, and 10-year yields fall dramatically in a recession. And I thought we were close. We'd raised interest rates by 375 basis points at that time. And I thought that was going to be enough to slow the economy and get inflation under control. So if that proves to be true, and inflation is peaking, which until the last 2 weeks, you thought it might be. But every time we get new information, we reserve the right to update our forecasts. And the new information is the labor market's running a lot hotter than people expected, and inflation seems to be stickier. And some of the good news on inflation, the supply chain healing news, is over. So that's why I thought 10-year yields at peak. I think we'll test them again. If we get a no landing scenario, it's quite likely we'll not only test a 4.25% again, but maybe blow right through it. So that's one of the implications of late cycle dynamics, is trying to figure out kind of where things are going to land. Let me do a couple of slides real quick, and we'll try to wrap it up with some final questions and maybe a conclusion. This is one of the things that you will feature into any late cycle, higher market vol. In 2022, we had 46 days that were plus or minus 2%, and it's the highest since the great financial crisis. So far this year, we've only had one, which is kind of nice. The positive and negative 2% days were, by the way, evenly split, which was good. But there are periods of time, like 600, almost 700 trading days, you don't have a 2% day. And it doesn't matter what the size of the market is. This is percentage. So S&P, maybe, back in the post-great financial crisis, 6, 8, 10, whatever, 7. Then there's these 2 years, 2020, which was COVID, and 2022, which is monetary policy dissonance, I guess is what I would call it. A lack of kind of a real strong feeling about where monetary policy was heading and when they were going to be done causes this volatility. Oh boy. Here's what I'm going to say about this chart. If we were on the post-great financial crisis trend in the S&P 500, we'd be at about 3,900 on the S&P right now. We're at 4,140. So I think the Federal Reserve is looking at the level of the S&P and saying, we don't need to step in right now. This has to do with the concept of the Federal Reserve put. The put is the Fed will step in and support the equity market when it goes down X%, fill in the blank. And historically, that X% has been, call it 20, plus or minus. So what the Fed will do is say, okay, we're going to lower interest rates, or we're going to buy some bonds, or we're going to support, or just say they're going to support the equity market. And that was enough to basically apply a put, that is a floor on the S&P going down. So the floor is much lower now because of what happened in the post-COVID crisis rally. So this blow off up to 4,800 was totally off trend, I guess I would say. And it's not because, the trend of the S&P should be kind of the trend of the corporate profits or trend of the economy. And the economy didn't all of a sudden become infinitely more productive between 2022 and 2020 and 2022. So this didn't make a ton of sense, and it was probably fueled by Federal Reserve monetary policy accommodation and a lot of fiscal stimulus, which just brings forward growth. So where are we today? About where we probably should be, but maybe a little above. So that's the point of this chart. Don't expect the Fed to ride to the rescue. I wrote a memo back in March of 2020 when we were here on the S&P. Actually, we were about here on the S&P. And I said, the Fed's going to ride to the rescue because they can't afford not to. We'll be in a depression if they don't. So I want to talk just for a second about corporate profits, because that's important. Right now, the consensus for 2023 is $226, and that's an 18 times. That's a little higher than the 20-year average. So it's not entirely clear to me that the equity market is cheap. It might be fair, but it's shading to the rich side. we use a sensitivity analysis to basically say what would happen if earnings were revised up or down 2 to 8%. If earnings get revised down 8%, well, then the equity and the multiple stays the same. It's the S&P 500 PE ratio times the earnings per share that gets you the level of the S&P. So you can manipulate either one of those. It's a two-factor model. If monetary policy is going to be much tighter, then you have to move this multiple down. If monetary policy throws us into a recession, then you got to move the EPS number down. So, the likely outcomes here, if the Fed has to raise interest rates more than 5%, much more than 5%, and that does the trick. Who knows if it's 6%? Neil asked the question, why stop at 6? The answer is, I don't know. You could go to 7 if you had to, but that is a total outlier. The Fed's not going there anytime soon, because 7% Fed funds, by the way, would most assuredly cause, let's just say, ruction in the market, and the Fed doesn't need to go there yet. Inflation is doing kind of what it's supposed to do. It's just taking a little longer, and monetary policy works in lags, long and variable lags. So we don't know yet what the 475 basis points or 450 basis points, we're at 4.75. The 450 basis points of rate hikes, we don't know what they've done to the economy yet. We haven't seen the full weight of those rate hikes yet take a hold. So this is kind of how we look at the valuation metrics in the equity market. This is how we look at the bond market. I mentioned 4.25 was the peak. I don't know if we get a no landing scenario, then this is 230 years of interest rate data. This is the 10-year yields going back to the 1790s. We were at such a low level. We were at 50 basis points 2.5 years ago. We're now at close to 4%. We're 370 today, or 380 now. So again, just a tug of war between recession and inflation is what's caused this. Where are we headed from here? Who knows? If you tell me if it's a recession, we're going down. If it's a no landing overheating scenario, we're probably going up. So one of these days, we're going to have to get back to something more normalized. Bond markets never lost money 3 calendar years in a row, but over a 3-year period they have. So calendar years, I don't know. This is not a really, it's kind of interesting. We're up 1.4% year to date in 2023. 2022, 2021, horrible years. This is the worst bond market on record, going back 200 years. This is data that we have. But every time back in the 50s, you had a couple of -2 years that were minus, and then you had pretty big years. I'm not predicting that, but the bond market will do very well if we have a recession, which is why you wouldn't hold 6-month or 9-month T-bills for very long, because T-bills don't rally in a recession. 10-year bonds rally in a recession. Keep that in mind. The protection for a recession is not treasury bonds per se, or treasury bills. It's certainly not treasury bills. It is the more duration you have, the more interest rate exposure you have, the better. Now we finally get to the yield curve, and then we can start wrapping up here, I think. The treasury curve, the 2s, 10s curve is the green. 3-month 10-year is green. The 2s, 10s is orange. I think the 2s, 10s gets all the press. It's -83 right now. But in terms of the most predictive, 3-month 10 years is the better number, I think. So what you want to do is look at both of them, recognize that they don't have perfect predictive powers, but this is sending you a very strong signal that we're headed to a recession. Yields are up across the board. Oh, sorry, Julian, did you have a question?
So I was going to just ask about some products specifically, or asset classes, about commodities. I've done well in 2022. How do you think about commodities in a portfolio in the next few years? And another one was about income funds in particular, providing yield and more stability. How do you see them fit in a portfolio?
So I'll start with the income funds. Income funds generate income for a reason. They generate income because they're taking credit or duration or volatility risk of some sort. If it's credit risk that the income fund is taking, whether it's in ABS or securitized markets or credit markets, either way, income funds will not protect you as well in an economic downturn as what we call pure interest rate duration. Pure interest rate duration comes almost exclusively from treasury securities. You get interest rate duration in a corporate bond, but you get credit spread duration too. And sometimes those work at cross purposes. The interest rate duration helps you in a recession, but because bond spreads widen, that negates some of the impact. The only thing you want to own, if you were lead pipe certain you were going to be in a recession, is 30-year treasury bonds. 30-year treasury bonds rally hard, and the price movement is very sensitive to the yield movement. So yields coming down a little bit means the price movement is very high. That's because they have very high duration. So what do we have? Global yields, U.S. high yield munis and U.S. high yield. This is where we stand today. They're much more attractive across all global bond markets. 2-year yields here, 10-year yields here. It's inverted, and they've moved up in the last year. Fed funds is up 450 basis points. Every single global market here, including France, is up by at least 40 to 450 basis points. So what we have here is simply a market where Treasury and other yields are much more attractive. And I'm not going to talk about the dollar. Here's the commodity question. So let me get to that. If China reopening is real, then copper has already begun to sort of respond to it. And oil should go, I've heard some estimates as high as $100, maybe more. So that's the story of commodities. It's China reopening is a commodities story. So we do have some what I would call real asset protection in the strategy portfolios, couple percent. That's a hedge that worked really well in 2022, as the listener mentioned. It will work again in 2023 if we're in a no landing scenario or a China reopening scenario. China reopening boosts the probability of a no landing scenario, by the way. So I don't want to talk about much related to the debt ceiling, except to say this: the U.S. is never going to default on its debt in our lifetimes. It's being used as a political tool, and we do need help. By the way, here's the debt ceiling going back to the 70s. It's been raised successfully 65 times. So once we get to the debt outstanding is the orange line here. Once we bump up against the green line, which is the debt ceiling, we just raise it. We raise it automatically because that's the right thing to do. It's not there. It doesn't serve the purpose it's intended. It's a silly law. It should probably be eliminated. But we do have a budget problem. And as long as interest rate on the Treasury debt is increasing at a high rate, this is the average interest on U.S. Treasury debt, went from basically 1.5% to 2 3/8, and now it could go as high as 3.5 very quickly because interest rates have risen so fast. How does that translate into interest paid in dollars? Defense spending on the 2020 budget was $700 billion. On our estimates, by 2025, net interest could approach the size of a budget line item as big as defense. So again, the CBO just published a bunch of budget data. It's important to look at it. Here's one piece that came out of it. I just quickly cut and pasted it. Net interest outlays could increase by 1.2% of GDP in the next 10 years. If that happens, and this is budget deficits, by the way. Primary budget deficit or surplus is here. It's total debt or deficit or surplus is here. The primary, which is X net interest costs, is here, but interest costs is the lighter pink. So it's really an important metric. We got to get a handle on it. Don't use the debt ceiling as your cudgel, because it's not effective, and it could create significant problems for the economy. A debt default by the United States, which is not even contemplated. It's contemplated by some, but only in their worst nightmares, is not something we want to experience. It would be immediately rectified once the consequences were seen to be horrible. So let's just leave it off the table. It should be taken off the table completely. It shouldn't be part of the political discussion. It should just be, we should fix the budget deficit. We should put our fiscal house in order, or we're going to have a problem down the road again. But the debt ceiling is not the way to do it. Are equities rich, cheap, or fair? Probably rich based on this equity risk premium calculation. It's rising. As 10-year yields go up, the equity risk premium goes down. Basically, the equity risk premium is the earnings yield minus 10-year yields. So as the 10-year yield rises, the equity risk premium declines. Looks rich to me. The other compensation for risk metric we look at is spreads on high yield and investment grade bonds. High yield and investment grade probably were a buy for about a cup of coffee a couple of times in 2022, but I didn't act on it. Spreads were pretty high, both for IG and for high yield. They're back down kind of in line with their longer term averages. So we don't have a strong feeling about corporate credit and taking any credit bets in the portfolio right now. I like this slide because it shows the actual real yields across a bunch of different municipal bond credit rating categories, from AAA all the way out to high yield. Same for IG corporates. This is AA corporates all the way out to single B corporates. what you see is if you take this is the nominal yields in the gray. The real yield tells you if there's any value. A year ago, there was no value. A year ago, we were looking at municipal bonds and corporate bonds that had low or no compensation for risk. Now you're getting compensated for risk taking. We're positive across the entire credit spectrum. And as you go out the credit spectrum, you get paid more in a real basis. So this is the outlook for 2023. It's what I presented in December. We haven't moved materially off of this expectation. At the time, I thought maybe a good range for the S&P might be 34 to 4,000. At the end of 2023, we're at 4,100 right now. So there's probably information in the fact that the high end of the range is below where we are today. At the time, the current level is 3,900. I thought the Fed would peak at 4.5, but now they're for sure peaking. Sorry, I thought they'd peak at between 4 3/4 and 5 1/4, and that still looks pretty good. Could go to 5.5. At the time we were at 4.5. GDP was 3%. I think we're looking at zero, basically a flat year in 2023, and 10's rallying because with a flat economic environment, it's likely the Fed would start to lower interest rates. We're going to be bumping up against it pretty soon. So let me just say this. How have we positioned in late cycle dynamics? Well, overall, because the environment is very uncertain, and because the environment is so uncertain, you want to be neutral risk overall. But there's things you can do under the hood, like add a little bit to value stocks by taking some allocation from growth. We did that a year ago, actually in the fourth quarter of 2021. That was helpful. But you want to stay pretty close to your strategic allocations. And by the way, being pretty close to your strategic allocations means you're not making major moves. You're not taking 10% out of 20, or if you had a 70-30, you're not taking 70% out of equities and putting it into cash. That's just that's not a sophisticated way to manage portfolios, but it might make you feel good in the short run, but it'll make you feel bad in the long run because you won't be able to get back in. And by the time you get back in, equities will be much higher. So what we really do like almost always is exploiting market inefficiencies that are structural, that are persistent. And you do that when you invest in alternatives. And some of the funding vehicles in alternatives are complex and they require specialized expertise. And you get paid, if you're willing to get into those markets, you get paid a complexity risk premium. So that's private equity, credit, and real estate, and hedge funds. Interest rate risk, we've increased it and back to neutral effectively. So we're neutral. Interest rate risk isn't going to hurt us plus or minus versus the benchmark. It's not to say that you wouldn't have a negative absolute return if interest rates rose dramatically, but they're not going to go up another 400 basis points from here. That would not be part of our expectation for sure. So we added duration back at higher yields, which we're back to now. Bonds rallied, then they went back. But right now, overweight U.S. large cap. And by the way, overweight international stocks, that's a dollar bet. If the Fed has to continue raising interest rates, the U.S. dollar will not continue to decline. And you need basically the U.S. dollar to decline to make unhedged international stocks really attractive. But they can be attractive anyway because they're frankly, the valuation metrics are in their favor. So I'm going to stop right there, see if there's any more final questions that are on the list. And if I don't get to them, we'll try to capture them and answer them if we can. I'm going to do a lightning round real quick here, Julian, and just answer a bunch of questions. I don't want to discuss inflation bonds because you can only buy a maximum of 10,000 of them. Inflation is a result of the money supply. That too much cash chasing too many goods and services. That is true in a certain respect. And Milton Friedman is a hero of mine from the University of Chicago. So I agree with that for the most part, which is why the Fed is trying to lower the velocity of money, which means lowering economic activity to try to put downward pressure on money supply. See the quantity theory of money for more on that. If Japan abandons yield curve control, does that put significant pressure on U.S. bond prices? No, not as much because they are going to have to abandon it sooner or later. They have not to date, but their balance sheet is also, I mean, they're the only ones adding to their central bank balance sheet in the current environment, Japan. Global bond yields overall have kept interest rates in the U.S. down because global bond yields have been much lower, particularly in Switzerland and Japan. But abandoning yield curve control doesn't mean JGBs go from 50 basis points to 300. So I don't see it being a huge, it'll have an effect for sure. A couple others in here. What's the difference between no landing and stagflation? The answer is one is a lower economic environment and higher inflation, whereas no landing is overheating of the U.S. economy, where GDP is actually rising, Carolyn, instead of declining. Stagflation is the 70s. The no landing scenario is simply an overheating U.S. economy that will be met with higher Fed funds rate. Julian, any other questions that you see that we need to address, or shall we kind of sum up here?
No, I think you address all the questions that are interesting to the audience. Then there'll be some follow-up for one-on-one questions that are more like portfolio specific. I think we can wrap it up now. So
if I were to summarize where we are today, the part of the story is the bad news from 2020 is sort of good news in 2023. That's at least in the bond market. But until inflation is going to become under control, so as soon as the Fed can get inflation, or until the Fed can get inflation under control, they're going to continue to try to provide a headwind to the U.S. economy, and that may cause corporate profits to decline. And higher interest rates are going to cause the denominator in the discounting mechanism of the U.S. equity market to cause equities to go down. So there's challenges that risk assets face, but bonds are useful in this environment. Bonds can provide a hedge. So that's what we're looking to do. We're building portfolios with the long term in mind. We're looking to diversify them into some of the areas that have been less attractive, especially over the last 10 years, which would include international equities. And frankly, for those that can give up some liquidity, alternative investments really work well. The focus should be on risk management, and risk management means not going all to one student body left or student body right. That means not deviating dramatically from the strategic allocation that you, with your advisor or consultant, have determined to be the most appropriate level of risk taking for you at this time. Unless your liquidity needs have changed, your risk profile probably hasn't, which means stay the course. So get invested, figure out what your appropriate risk profile is, and know that the market's going to be volatile, and that's the price that you pay to build wealth. With that, I think we can wrap it up. Julian?
Thank you, Michael, and everyone. So please look out for invite in your email inboxes for next quarterly macro and market update, and that will be around the middle of May. Until then, be safe. And to wrap up this call with a quote, in investing, what is comfortable is rarely profitable. See you all next time.
See you, everybody. Thanks. Bye now.